So now let's get into the question. In constructed response question, first of all, what you have to do is read the requirement. After reading the requirement, read the scenario. So let's read the requirement. Part A, what they are asking is calculate the market value after tax weighted average cost of capital of AQR company in the following circumstances: before the new issue of the bond takes place, after the new issue of bond takes place. So they are asking us to calculate the after tax weighted average cost of capital. So this is what they are asking, before and after. So in this question there is some bond issue, so keep that in your mind. And they are asking us to comment us on the findings. And part B, what they are telling, discuss the director's view that issuing traded bonds will decrease the weighted average cost of capital of AQR company and thereby increase the market value. So some director has given some comment on that. Some view is there for the director with regarding to the weighted average cost of capital. So when we are reading the scenario, now we can understand there will be something like this. So now let's read the scenario. When you are reading the scenario, very important, make sure to note down whatever the important points. So you have a scratch pad in your exam. In the scratch pad, make sure to note down everything. If not, you can keep the important points in your mind as well. The finance director of AQR company has heard that the market value of a company will increase if weighted average cost of capital of the company is decreased. So what this director is thinking, if weighted average cost of capital decreases, the market value will increase. The company, which is listed on stock exchange, has 100 million shares in issue. So I'll highlight that point. The current ex-dividend share price is, so they have given the ex-dividend share price, it's $2.5. AQR company also has in issue bonds which has a book value of 60 million. And their ex-interest market price is 104. So market value is given, it is 104, which is $100 bond. The recent dividend per share of the company are as follows. So they have given the dividends from 2000 to 2004. The finance director proposed to decrease the weighted average cost of capital of AQR company. So finance director is suggesting to somehow reduce the weighted average cost of capital of the company and hence increase its market value. So as the company's directors are thinking, finance director also telling, okay, let's try to reduce the weighted average cost of capital, so it will lead to increase in the market value by issuing 40 million bonds. So in order to do that, what they are expecting to do, they are going to issue 40 million bonds. And another key point that I want to tell you, this is another one mistake most of the students are making. When they are reading the scenario, they will read for the just sake of reading it. Don't do that. When you are reading the scenario, even though you take time, no problem, read it with the proper understanding. It might take additional 1 minute or 1.5 minutes. Not a problem at all. Read with the proper understanding. Don't rush through the scenario. Take your time and read it. At the nominal value of $100 per bond, this bond would pay annual interest of 8% before tax. So it's a 8% bond before tax, would redeem at 5% premium. So redemption is given, it is redeemed at 5% premium to the nominal value after 10 years. So it is going to be a 10-year bond. So we read the requirement, we read the question, now you have the perfect idea in your mind. Now again let's go to the requirement and we'll get the proper idea of the requirement, because in your mind now you have the scenario. So let's read the requirement again. Calculate the market value after tax weighted average cost of capital of AQR company in the following circumstances. So in this question we have to find out what's the cost of equity of ordinary shares, what's the market value of ordinary shares, what's the cost of the debt, what's the market value of the bond that they have given. So if you know these four elements, you can calculate the weighted average cost of capital before the new issue of the bond is taking place. Okay. So in order to calculate the cost of equity, we have to use the dividend valuation model. So I'll type the formula here, but in your exam you all are not required to type like that. Why am I typing is because for you all to get an understanding. So cost of equity equals D0 into 1 plus G close the brackets, divided by xp0 this entire thing plus g. So here you can see in this question, for you to get the answer, you need the growth rate. So how to calculate the growth rate? Using the past dividends that they have provided. So how to calculate the growth rate? You know, here 19.38 dividend has increased to 21.80. so this increment has happened over how many quarters? 1 2 3 4, over 4 years, not quarters, over 4 years. 1 2 3 4, over 4 years your 19.38 dividend has increased to 21.80. 2000 2001 1 year, 2001 to 2002 2 years, 2002 to 2003 third year, 2003 to 2004 fourth year. So over 4 years it has increased. So I'll type it here. Again, this one also I am typing for you all to get an understanding. 21.80 equals 19.38 only has increased to 21.80. So this into 1 plus g to the power 4. So this has increased over 1 2 3 4 years. So let's calculate the growth rate, guys. I'll directly type the values here. Growth. So when I am typing the formula, please give your focus for the formula, guys. Open brackets, 21.80 divided by 19.38 to the power, open brackets, 1 over 4, this entire thing minus 1. So here you are getting a growth rate of how much? 3%. Now let's calculate the cost of equity. So D0, the dividend which they have paid 21.80, keep in your mind they have given this one in cents. So I am going to do the calculation in dollars. So let me open a bracket, 0.218 into 1 plus g. So growth rate I am not going to type it, I am going to link it. In your exam also you will have to do like that. Don't type it as 3%. Close the brackets, divided by, this answer should be divided by your xp0. So the market value they have given, x dividend ordinary share price is how much? 2.5. So 2.5, I'll put another bracket to be in safe side. This entire thing plus the growth rate which is 3%. Again I am linking it. So how much is the cost of equity I am getting here? I am getting a cost of equity of 12%. So that part is done. Now let's calculate market value of ordinary shares. Market value of ordinary shares. So how many shares are there in the market? 100 million shares are there. Each share price is 2.5. So 100 million into 2.5. So here you are getting 250 million. So here inside the brackets I'll type and keep this is in millions. If not, we will forget it. Okay. So now let's do the calculation for the bonds. So bonds, how much is that? The current after tax cost of debt is 7%. So they have given after tax cost of debt rate is given, it is 7%. So nothing to calculate. So I'll type and keep it here. Cost of debt after tax value they have directly given it, which is 7%. And we have to calculate the market value of bonds. So market value of the bonds are how much? One bond is 104. There are 60 million book value bonds are there. So if you divide that 60 million from 100, you will get how many bonds are there in the market. So if you divide 60 million from 100, you will get 600,000 bonds are there in the market, and each bond is trading at a value of 104. So what's the market value of the bond? It is 62.4 million. So here let me put the currency. This is 250 million and this is 62.4 million. 62.4 million. So you have the cost of equity, you have the market value of ordinary shares, you have the cost of debt, you have the market value of the bonds. Now let's calculate the weighted average cost of capital. So let me add a column here, guys. In your exam you all can't add columns like this, okay? You'll have to type it in the proper place. So here this is question A, Roman number 1. Question A, Roman number 1. So weighted average cost of capital before new bond issue. So I am giving a perfect picture for the examiner. Examiner here, see, this is the weighted average cost of capital before the new bond is issued. So let me calculate it, guys. Open brackets, this market value into 12% plus, again open brackets, this market value into 7%. So my numerator is done, so I will close the brackets fully. So inside this bracket my numerator is there. So now let me enter the denominator values. So for the denominator you have to take the total of the market value of ordinary shares and the bonds. So again I am not going to type anything, I am going to link it. So take C8 cell plus your market value of the bond C11. So close the brackets, make sure to use the brackets properly. When you open a bracket, make sure to close it. So here I am getting an answer of how much. Let me take the answer for 2 decimal places. So here I am getting an answer of how much? 10.97%. So before the new bond is issued, the weighted average cost of capital is how much? 10.97%. So next what they are asking is calculate the weighted average cost of capital after the new bond is issued. So let's calculate it. A, Roman number 2. So in order to calculate the weighted average cost of capital, I need the cost of debt of this new redeemable bonds. So let's calculate it. Issue price, interest and redemption value. So issue price is how much? 100, and interest is how much? This is a 8% bond. So 100 into 8%, but you have to take the net of tax value. So because we need after tax rate, no, to get the net of tax, 1 minus T, tax is 20%. So here you are getting 6.4, and next what they are telling is, sorry, tax is 30%, guys. Tax is 30%. So here you are getting 5.6, and at the time of redemption here they have given you can redeem it at 5% premium. That means you will get the 100 par value, top of that another 5%. So in total how much you will get? 105. So let me calculate the present values using two discounting factors, because I want to calculate the IRR. Maybe 5% I will take. So here I am getting 1. Let me increase the decimal numbers. 5%. Let me take it here, and this is year 0, year 1 to 10, year 10. So year 1 to 10, 5%. What's the annuity factor I am getting? 5%, 10 years annuity factor 7.722. And next one, 5%, 10-year discounting factor 0.614. So let me calculate the present values. This value into discounting factor. So I'll copy paste it. Let me change the decimal numbers. Let me make it 2 decimal places. So here how much is the NPV that you are getting? You are getting an NPV of positive 7.71. So to calculate the IRR you need a negative NPV. So let me copy paste it and change the rates. Maybe 6% I'll take 6%. So 6%, 10 years annuity factor I can get 7.360, and discounting factor I can get 0.558. So here I am getting a negative NPV, so I can calculate the IRR now. So let me calculate the IRR. Oh, IRR, if not it is the cost of debt of new bonds. So let me calculate it. 6% minus 5% divided by, I'm going to enter the values for denominator, this amount minus this amount into this amount, this entire thing plus 5%. So here I am getting a IRR of, or cost of debt of new bond is how much? 5.98. So I got that rate. So I have to calculate, get the market value of the new bond. Market value of new bond. So how much is the market value? I am going to get 40 million actually. So 40 million. Here I will copy paste this. So let me calculate the new weighted average cost of capital. So let me finish off the numerator first. For this amount, this percentage. So you can see the formula here, plus for open brackets for this amount, this percentage, plus for this amount, this percentage. So that entire thing is my numerator. So let me put another bracket. Let me get the denominator value, open brackets, my total equities and liabilities. So this amount plus this amount plus this amount. So how much is the new weighted average cost of capital that I am getting? It is 10.41. If you just calculate these numbers, you can't get all 12 marks according to the question. If you calculate just numbers, you can get like maybe 10 marks. Okay, so what they're asking is comment on your finding. So how we are going to make a comment on this? Now here you can see before the bond is issued, your weighted average cost of capital is 10.97. Now weighted average cost of capital after bond is issued, it is 10.41. So here see what has happened, your weighted average cost of capital has been reduced. So you can make a comment saying that as your first point, weighted average cost of capital has been reduced because your debt is cheaper. Now here see, if you are taking equity, equity cost is how much? 12%. But here see, the debt cost is how much? Only 5.98. Since debt is cheaper, what happened? Your weight reduced. So that is a one point that you can mention. But another point that you can mention, even though the debt is cheaper, if we finance through debt, what will happen? Our gearing will increase. If our gearing increases, the financial risk increases. If financial risk increases, to compensate for the additional risk the shareholders are taking, the shareholders will demand for a higher return. So that point also you can mention. However, if you obtain the finance from debt source, it will lead to increase in the financial gearing. So if financial gearing increases, the risk will increase. So to compensate for that, equity holders will demand for a higher return. So that one should be taken into the consideration. So if you can make these 2 points, you will get all
12 marks.
I have done a comprehensive revision for ACCA Financial Management FM or F9 syllabus for a very reasonable price. You can purchase this revision through the link available in the description. In this revision program, I have covered 120 plus MCQ type questions and 6 constructed questions. For each question, I have given you detailed answers and I have provided some additional learning as well. So I hope this revision program will be useful for you in order to pass your exam. If you like my video, don't forget to like it, share it and make sure to subscribe my channel.